Good evening, everyone. Welcome to the weekly webinar Let's Trade Live. This is Wayne, Head of Research and Education on behalf of Fullerton Markets. I warmly welcome everyone. So as usual, the webinar will be divided into three segments. We'll look at what has happened in the past 1 week. Then the second segment will look at the calendar for some news trading opportunities. And our final segment will go straight to the charts. I'll take the requests as they come along to look for trading opportunities as well. Feel free to type in any questions that you may have. I'll take them along the way. Let's jump straight to it. For last week, the key one is basically Fed interest rate announcement. They have raised their interest rate for the first time. But interestingly, the US dollar weakened in the first hour. So some of you who are, or rather has been watching the market will know that the dollar yen dropped more than 100 pips in the first hour. So this is a bit of a counterintuitive move. General rule of thumb is when central bank raise interest rates, it should strengthen the currency. But in this case, it doesn't. So I wish to take this chance to highlight that that is just a general rule of thumb. But what precedes it is basically market sentiment. Very important when we are trading the market, we need to take note of what is the market sentiment and what is the market expectation. So prior to the interest rate announcement, it is already expected to raise interest rate. So market is already very sure that they will raise interest rate, or rather they are expecting it to raise interest rate to the point of 100% sure, that kind of level. So that's why at the point of them announcing the interest rate hike, what the market is looking out for is the next rate hike. What is the clue given to them? So they want to see they want to hear from Fed Chair Janet Yellen some clarity in terms towards the next rate hike, especially give them maybe a clearer date. But unfortunately, Janet Yellen did not deliver up to the expectation of the market. So that's why there's a sell-off in the dollar, and there's a change in market expectation of June rate hike as well. Prior to the meeting, it was the next rate hike in June has a probability of about 60%. But after the FOMC statement, it dropped below 50%. So that's why we see a sell-off in the dollar. So of course, for the next few weeks or even months to come, what is the next thing to look out for is basically if there's any speculation of rate hike in June or increase in chance of a rate hike in June, then of course it is likely to see the dollar strengthening. But for now, dollar will remain on the weak side because there is no expectation of, or rather there's no high expectation of rate hike in June. So for now, the price is likely to fluctuate between the 112 and 113 level. So of course, towards the final segment, we'll go on to the charts to take a look at dollar yen if some of you request for it. Okay, the next key thing to take note is this is on the Brexit development. UK Parliament gives Theresa May permission to start Brexit. So this is extracted from Bloomberg report. So a very quick summary, as you can see, next steps to Brexit. They need to achieve these three things. And based on the latest news that I just received, or so-called read from internet, actually Theresa May is prepared to invoke Article 50 by end of this month, around 29 March. So the next question is what happens next as usual? So after they invoke Article 50, of course, it starts the process of exit meaning there will be a lot of negotiation between UK and EU, because all the existing so-called agreements, treaties will have to be renegotiated. So there will be a lot of negotiation to take place, and it is easily taking months to complete. So having said that, in summary, the actual effect of Brexit will most likely be felt after the negotiation completes, which could be as long as 2 years later. So having said that, the immediate reaction could be a sell-off in the sterling after Theresa May invoked Article 50. But after that, because the effect will only be known many months or even years later, the market may delay that effect to a later date, and they will focus back on Bank of England. Later we'll look at that, their hawkish tone instead. So if they do that, there could be a short-term drop in the sterling, but it is likely to recover pretty fast as well. So that's about Brexit development for now. And of course, the next one is the next central bank that has announced interest rate last week is basically Bank of England. And this is also the second surprise that happens to trader last week. The first one, of course, is when Fed increased interest rate, the dollar dropped. This is the next one. The least expected to be hawkish, and they became hawkish, Bank of England. So there was a rally in the sterling all the way up towards 1.24 level. So the main reason, of course, prior to the meeting, 9 out of 9 of the MPC members, Monetary Policy Committee members, are expected to vote to maintain interest rate. However, the actual result was one of the member, Christian Forbes, actually voted for an increase in interest rate, interestingly. So of course, his reason is he don't see there's much reason to hold on to interest rate when the inflation are actually rising sharply. So his main concern is to raise interest rate to prevent the inflation from overrunning too fast. So as you can see, the chart on the screen, basically it shows the bars shows the GDP growth. So it is pretty healthy, maintaining about 0.5 to 1%, that kind of region. And the white line is basically the inflation rate. So since middle of 2015, you have seen that the inflation is on an uptrend. So if the trend continues, it should hit their 2% target within 2017. So that's why there's a concern on inflation overshooting their target. So that's why he voted for, he feels that it should increase, or rather BOE should consider increase interest rate sooner. And not only he's not the only one who shared the view. There are other few MPC members who feel that rate hike should come sooner than later as well. So overall, it was a hawkish statement. So that's the reason why the sterling rally. So that's the quick summary on the two major central banks that has made their statement last week. So very quickly, let us move on to the calendar for this week and see what are the data that could possibly give us some trading opportunities. The first one, as you can see on the screen, is tomorrow, Tuesday, 5:30 p.m. GMT plus 8. GMT plus 8 time zone basically corresponds to China, Malaysia, Singapore time zone. So that is tomorrow 5:30 p.m. That is the UK CPI. So this is a year-on-year figure. So the market is expecting the figure to come in 2.1%. So remember earlier, the concern of the central bank is the inflation is rising and exceeding their target. That's their concern. So once the inflation exceeds their target, they should start their tightening so-called cycle. So having said that, this is the 2.1% is what the market expected. So if the actual number is less than that, meaning market may start to scale back or may start to speculate whatever the central bank concern is may not be valid for the near term, so they may change their so-called hawkish bias in the future or the next meeting. So market may sell off the sterling because sterling has rallied on hawkish statement. But if the inflation comes in worse off than expected, then market may start to scale back that kind of expectation. So that's the reason we suggest this pending pound dollar trade if the actual number comes in smaller than 1.8%. The previous number is 1.8, so if the actual number is even lower than the previous figure, we are expecting there could be a sell-off in the sterling. So this is for your consideration. Of course, to highlight, if you are holding any Aussie positions overnight until tomorrow morning, 8:30 a.m., RBA Reserve Bank of Australia is scheduled to release their meeting minutes tomorrow at 8:30. So that may cause some volatility in the Aussie dollar. Be aware and manage your position across around the 8:30 a.m. time. So next we move on to Thursday, 23rd March. That's another central bank announcing interest rate this week. This is RBNZ, Reserve Bank of New Zealand. So market is expecting them to maintain their interest rate at 1.75%, no change. And our suggestion is to put a pending short on Kiwi dollar in the event RBNZ surprise the market by cutting interest rate. So if they surprise the market by slashing interest rate, we could possibly see the Kiwi dollar dropping. So that is our suggestion. And the next one is actually 5:30 p.m. on Thursday. This is the UK retail sales. Again, our suggestion is to put a pending short pound dollar in anticipating that the actual data is very bad, meaning it has to come in less than 0%. Market is expecting a growth of 0.4%. But in the event, if the actual number shows a contraction, meaning it is less than 0%, possibly we could see a significant sell-off in the sterling. So this is the reason for our suggestion for pending short pound dollar. Of course, the next one to highlight is, if you can see later on Thursday night, 8 p.m., Fed Chair Janet Yellen is scheduled to make a speech. Of course, since last week was FOMC, this week we do expect her to maybe maintain her bias in her speech. It shouldn't. We don't expect her to change her viewpoint within a week. There's not much of data that is released between last week and this week for her to justify for any change in her statement. So high chance is she will just maintain or reiterate what the FOMC statement or the Fed statement has mentioned. So however, we never know. I'm not the Fed chair. Never know what she will actually say on 8 p.m. Thursday. So if you have any dollar position, this is something for you to take note. On Thursday 8 p.m. at least, if you have a open position with any of the dollar majors, then at least you can manage your risk as the time approaches. Don't get caught by surprise. So that's the news calendar for this week. Okay, so before we move on to the charts, a quick announcement. This is the accelerator bonus, our most popular bonus that we have offered to our clients. Feel free to check us out. It is fullertonmarkets.com/promotions. The other announcement that we like to make is Fullerton Leaders Summit. This is in conjunction to celebrate our first anniversary next month. Yes, time flies. Fullerton Markets has been in the market for 1 year, and we are celebrating our first anniversary next month. And one of the event is Leaders Summit, which will be held in Bangkok. So the date is 29th and 30th. Do lock in your early bird discount price for the event. And that's the link for you to sign up if you are interested. offers.fullertonmarkets.com/en/FLS. So for those of you, the event will be held in Marriott, Bangkok. For those of you intend to go and you wish to get a corporate rate for Marriott, feel free to live chat with our support or drop us an email at support@fullertonmarkets.com and request for a corporate rate, and we will liaise for you for the hotel accommodation. So very quickly, we'll move on to the final segment. Let's go to the charts. So feel free to type in the requests, the symbols that you want me to look at, and the time frame as well, whether it's a M15 chart, H1 chart, H4 chart, or daily chart. While you are typing in your requests, I'll look at the charts that we have looked at during our last webinar, which was 2 weeks ago. I skipped 1 week last week because I was traveling. But anyway, we will look at the charts that we have talked about 2 weeks ago. So the first one, this is the Aussie Swiss franc. So my comment is still on the chart. As you can see, my entry criteria is applicable after Reserve Bank of Australia's statement. So basically, the vertical line on the right side, the rightmost vertical line, as you can see, that marks the time where RBA released the statement. So meaning to say, after that candle, my entry criteria applies. So at the next candle over here, where my red arrow is pointing to, that would be at the opening of the candle. It fulfills my criteria because the candle closes above the 0.7684 area. So the next candle, possibly we could go long. So the full move is not a lot from the opening price all the way to the highest point is about 44 pips. So this is not a very big move, but out of these 44 pips, if you can grab like 10-20 pips, that's not bad as well. So of course, for this case, this is how much the market allow us to take. So that's the Aussie Swiss franc trade that we have looked at last week. Oh no, 2 weeks ago. Then of course, the next one that we have looked at is pound yen. So vertical line is the time of the webinar. It's the comment over here. If a bearish engulfing pattern forms, that is my short signal. So that was my comments 2 weeks ago during the webinar. So as you can see immediately, this is an hourly chart. 1 hour later or 2 hours later, there's actually a bearish engulfing formation. So I'll zoom in bigger so that you can see on your screen. Just give me a moment. Yeah, there you are. So if you can see where the green box is, you notice the bull candle is very small, the bear candle body is bigger. So this is the typical bearish engulfing pattern. So my comment given during the webinar is, if a bearish engulfing pattern forms, that is my short signal. So my short signal after the formation, I would enter over here at around 139.50 plus minus. And my stop loss would be in the region of the red zone over here. So 13980 plus minus. And my first target is where the blue zone over here, 13906. So you will notice, even if it's a plus minus a few pips, if it's supposed to hit into the blue zone, it will hit regardless. So for this trade, it hits the first milestone. So first milestone meaning either I will shift my stop loss to break even and do a trailing stop, or I can choose to exit everything. So the full move, as you can see over here, for this signal, market has given me a full move of about 110 pips. So out of this 110 pips, if I can grab about 50 or so, or you can grab about 50 or so, that will be fantastic. So that's the pound yen chart that we have looked at 2 weeks ago, and the next chart that we have looked at is CAD yen. Okay, CAD yen, this is the CAD yen, and you notice the green area is where I say if candle closes into the green area or lower, that's possibly the signal. So as you can see, this bear candle actually fulfills my criteria for a short entry. And my stop loss is either of the red zone. The lower red zone, of course, is a more aggressive stop loss. The higher red zone is a more conservative one. So in this example, regardless of whether it is a tight aggressive stop loss or a conservative stop loss, it will hit eventually. Market reverse upwards. So that is CAD yen. And dollar yen. So this is dollar yen. So dollar yen, I mentioned for shorting this pair, I would use a pending short during ADP and or NFP expecting bad data. But we all know that the ADP and NFP that was 2 weeks ago, the information, the data was better than expected. So anyway, doesn't fulfill criteria, even if I doesn't fulfill the criteria of my pending short order. So the signal that I gave is over here, the green area 114.20. If candle closes into the green area or higher, that would be my signal to go long. So as you can see, this candle over here where my red arrow is pointing. So the candle closes into the green zone. So it fulfills the criteria, and the entry price at the next candle is 11420. That would be a long trade for this chart. So the full move over here, as you can see, is about 130 pips from the entry price all the way up. So depending, if you can grab even the first move over here, you can easily grab about 50 pips. So that's the dollar yen chart that we have looked at. And next is Kiwi yen. We have not, I mentioned that it is close to the support, so not an ideal trade for me to take. So that's why I did not mark any suggestion, or rather I did not put any criteria for my trade. So of course the last one is actually gold. The vertical line is the time of the webinar. So I mentioned possible sell signal once stochastic hits above 80, but stochastic did not go into the 80 region, and the price kept falling for the entire week after the webinar. So that's about it for the charts that we have looked at for last 2 weeks ago. Let's move on to this week, and I'm checking the request on my screen. Okay, the first request would be dollar CAD. Oh, there are a few requests made by one person. Okay, you should know who you are. Anyway, it's okay. The first request, dollar CAD H4. Let's look at dollar CAD H4. I'll remove all these markings. Dollar CAD H4. This is dollar CAD. So as you can see, the sharp drop is due to the weakening in the dollar, because Janet Yellen did not fulfill the expectation of the market. So anyway, now the market is sort of retracing higher. So the next FOMC is scheduled to be on May. Pardon me. March is coming to an end. The next FOMC is actually on the 3rd of May. So there's no FOMC scheduled in April. That means from now until then, there may be some speculations in rate hike by Fed, but chances is a lot will be driven by data instead. So if the data shows very positive growth, sustainable growth, then market may start to speculate. Maybe Fed will seriously consider another rate hike in June. So if that kind of speculation starts to appear, of course, then we'll see the dollar strengthen. Then possibly dollar yen may start to head higher. Okay, so for now, dollar CAD, I do expect the dollar CAD to start to consolidate if there's no so-called major driving force for this pair. But do take note that this week, towards the end of this week, if you check the news calendar on Friday, there is some Canadian news coming up. So of course that is on Friday night. So that could on Friday night could move the loonie a bit depending on the data. But for the rest of the week, from now until Friday, there's still about 4 days of trading, 3.5 days of trading. So during these 3.5 days, I do expect dollar CAD to more or less consolidate, hover in a sideways fashion. So based on the price action, this is what I'm seeing, the two level, 1.3370 and 1.3290. So this is about 80 pips so-called range. So I do expect price to fluctuate within these two figures. So if you ask me, on a H4 chart, it will be a bit challenged to look for entry. Because if you look at the candlestick, basically it doesn't fulfill my entry criteria to take any trade. And most likely it will give me an entry in the middle of nowhere, between 13370 and 13290. Most likely in the middle, and if it's the middle, my risk reward for this trade would not be favorable. So there's a few options for you guys. Okay, the first one of course is suggestion, apply range strategy, whatever range strategy that you may know of to trade this pair, at least for this week. Or the other option would be zoom down to a lower time frame and see whether I can refine my entry for my trade. So what I did now, I zoom into a lower time frame to try to refine my trade. Nope, I can't find any possible entry criteria. So what I'm doing now, I'm even zooming down to a lower time frame, as you can see over here, M15. So M15, if I don't usually trade the lower time frame, but if you ask me, if I force a trade, which is usually what I don't do, but for discussion purpose, and some of you, if you are trading the lower time frame, then you may consider my suggestion. So this is what the market is happening. So you may want to consider an entry over here for short, and the stop loss will be higher than the resistance. So I mark it with a red box, so that will be the stop loss, which is around 1.3380. Oops, sorry. Pardon me, I forgot it is low time frame. So this is 1.3383 plus minus 12 pips. That will be the red zone over there as a stop loss. So the entry price would be somewhere around 133.47. When the candle closes into the green box or lower, that will be a telltale sign for a short. So this is my suggestion for lower time frame trading. Then of course the target could be before it hits into support, where the blue zone over here. Okay, that would be the target. Of course, if you want to be more conservative, and once the price reach the higher blue zone over here, so this is the blue zone over here before it hits into the so-called immediate low over here. That would be the first milestone where you can consider at least shifting your stop loss to your entry price to protect your position. So this is dollar CAD, very short time frame trading. I put a vertical line there at the time of the trade. So this is dollar CAD, a suggestion for you. Let me look at the next request. That will be Aussie Kiwi H4. Okay, let's look at Aussie Kiwi H4. Take note that if you are trading Aussie Kiwi, the Reserve Bank of New Zealand interest rate announcement on Thursday morning is likely to have an impact on how this pair moves. So that's the Aussie Kiwi, and the request is to look at H4. Okay, so this is a H4 chart on Aussie Kiwi, and if you look at it, it's very nice uptrend, but the momentum is sort of slowing down over here, where the blue box is. Prior to the blue box, you will notice the push, retrace, push, consolidate, and then push. The push is usually quite significant, as you can see on the chart. But after this, the last strong push over here, you notice the next two push, which is over here and here, is actually shorter as compared to this push over here. So what is telling us, the bullish momentum is sort of slowing down based on the price action. So of course, when I say slowing down, it doesn't mean it will reverse. It just means that it is slowing down. But if you look at the chart, it is still uptrend. No sign of reversal yet. So let me mark the area for your consideration. Very tight region over here. Okay, this three area is quite close together. Okay, anyway, I'll put a price label first. I think I can shift this lower. Okay, plus minus a few pips doesn't make much difference. This is actually a round figure over here. Okay, I'll take this region for consideration. I'll zoom in. Okay, so it's easier to see. So 1.0940, 1.0900, and 1.0860. Very small for H4 chart. It is just 40 pips apart, as you can see, all this region. So for me to consider that the uptrend is coming to the end and possibly going into a reversal, in case some of you have that kind of question, I will need the price to reach this kind of level, at least below 1.0860. Then I will consider that as a reversal, possible reversal to happen. Anywhere above 1.0860, I will still consider the price as in a consolidation. Then of course, if the price goes higher, it is a trend continuation. So for this trade, the price now is really not a. If we were to enter for a trade, it will be over here after the bull candle, but now the price is heading upwards. I will still want to look for potential so-called long setup. So from now until Thursday, before the RBNZ announcement, and then for the RBNZ announcement, if you want to trade, you can like what I've highlighted, put a pending long instead for this pair. Earlier on, my suggestion is a Kiwi dollar. That's why suggestion is to put a pending short in case they cut interest rate or their statement is overly dovish. Then we could see a sell-off in the Kiwi. But now if we are talking about Aussie Kiwi, this pair, then I would be doing a pending long instead, expecting a dovish statement from RBNZ. So if indeed they release something dovish, then possibly Aussie Kiwi may hit beyond 1.10 round figure and higher. Okay, I'll put the round number there for your reference. Where is the big round number? 1.10, that's for your reference. So one of the possibility is if the candle closes above where the blue box is or higher, possibly I'll change to green color for possible entry. So this is a suggestion, a breakout suggestion for Aussie Kiwi. If not, if the price continue lower, okay, continue lower and bounce up from 1.09 region. So if the price does this and then it has a bullish candlestick formation, that would be another possible entry to consider. Alternatively, if that doesn't happen, market just pierce right through, then that would be, and if it has a bullish candlestick formation, again that would be another consideration. Of course, if you have taken a long trade over here and if the price goes further down, please do not take the second entry at a lower price. So for these two suggestion, it is either one, okay, because the last thing I want is if the price really goes into a reversal, these two trades will go into a stop loss. So decide which one you prefer, okay. And of course, if you make the decision to take both, then you can always manage your risk by reducing your risk, or rather divide your risk up for two trades, so that even in the worst case scenario, market really reverse, both trade hit stop loss, you don't suffer big losses. Okay, that's another way of doing it. Then of course, if there's no bullish candlestick formation, market just pierce right through, then the other consideration would be over here for a short instead, where the green box is. Yeah, the green box is about, yeah, that's plus minus, never mind. Slightly higher. Okay. So if the candle closes at about 1.0843 or lower, that would be my signal to go short. So this is the Aussie Kiwi H4 bond for me. And the next chart on my screen, Pound Aussie daily chart. Okay, let's look at Pound Aussie daily chart. Okay, what you are looking at over here is Pound Aussie daily chart. Okay, the sterling has weakened quite significantly against the Aussie. So fundamentally, Aussie is stronger as compared to sterling. Of course, the reason of sterling being weak, we all know. So even with recent so-called hawkish bias from Bank of England, the sterling did not strengthen too much against Aussie. So this is telling us that even with rate hike expectation, hawkish statement from BOE, the Aussie still has an advantage over the sterling. And if based on what the Brexit progress is, at the point of them invoking the Article 50, then possibly we may see the Pound Aussie heading downwards further. So this is currently is holding by the support over here. So looking at the price action, it is, you see that how price move up, test it one time, and now it's slowly creeping towards it again, trying to breach that level. So let's look at what is okay. You'll notice for daily chart, right, 10-20 pips is quite insignificant on a daily chart. That's the amount of movement is very little in the perspective of the chart. So that's why when most trader trading the daily charts, their stop loss tends to be in the region of 100-200 pips or even higher. So in any case, this is a daily chart support by the round number 1.59. So I'll put some round figures for your reference. At least you see the perspective. 1.6 is another round figure which is 100 pips away. So where is 1.6? And thereabout, this blue line, the blue line is about 1.6. So notice the gap. That is 100 pips. So that's the reason when I mentioned that when you are trading high time frame, and especially on a volatile pair like the sterling pairs, 100 pips becomes will become less significant compared to some of you who are trading the lower time frame like M1, M5 chart. 100 pips is like out of the screen already. So of course different time frame. That's the difference when you are trading a different time frame. So in any case, so the round number 1.6, 1.59, this 100 pips, I see it as a region to support the Pound Aussie. So that would be my signal to go short once a daily candle that closed into the green box, which is easily around another 100 pips lower. Okay, that would be a short. Okay, I'm going to zoom in so the candlestick looks bigger for you to see. Okay. So of course the region is still between 1.59, 1.60. This is quite a, I would say quite a strong support over here. So there are tail shadows that go beyond to about 1.58. So if there's a candle close, okay, I would like to stress again, candle close. I don't care about the shadow. If the shadow goes down, doesn't fulfill my criteria. The body has to close into 1.58 or lower, then it will fulfill my criteria to go short. So this is my suggestion for pound Aussie. The next, okay, let me see. The next request is gold. Okay, let us look at gold. Gold is, okay, there's a few requests on gold. Let me see. Okay, there's a few requests on gold with different time frame. What I'll do, I'll just cycle through the time frame and pick the one I would choose to trade. Okay, for gold, I would prefer to look at okay, H1 chart, because in my opinion, H1 may give me a faster entry. Okay, the gold has shot up. Of course, it's due to the weakening of US dollar. That's the primary reason why it has gone up. So over here, it is broken to a new high and retraced downwards. Of course, if you look at the recent price action for the last few days, I mean last few trading days, the upward momentum isn't that strong. So there's no reason for the dollar to weaken further, because that would mean a further scaling back in rate hike expectation. So currently it's below 50% for a rate hike in June. So unless there's speculation to scale it down to even lower than 40% or 30% or even lower, if that happens, then of course gold may hit higher. But for now, I don't see any possibility yet from the data or whatever. So chances is gold may start to consolidate as well. So if it goes into a consolidation, this is possible because after all, they have increased their interest rate once. So, and they are still looking into another 2 more rate hike this year. No change to that yet at this moment. So maybe market will come to realize that they have sell the dollar too much. Then if that happens, then possibly gold may head downwards again to maybe around this region, 1.225. So my suggestion is if the candle closes below 1231, around 1230. Okay, if it close into, if the closing candle is at 1230 or lower, that would be my signal to go short. And of course, my first milestone is just before it goes into 1225, where the blue box is. Okay, that is my first milestone. First milestone means I can choose to partially close my trade, and then if market chose to break 1225 to go lower, then I can write on the profit. But if it doesn't, then at least I took some of the profit. So my stop loss would be over here where my red box is. This would be considered aggressive stop loss, just higher than the bear candle over here. Okay, of course, a conservative stop loss for you to consider would be higher. So if you took a conservative stop loss which is higher, then the risk reward is not so attractive. So maybe it's about 600 over points versus 400 over points for the first milestone or the first target. But however, if we go with more aggressive stop loss over here, then we have a 1:1 risk reward for the first milestone. So that's a goal. H1 chart. Let's look at the next pair. Okay, I'm looking at NASDAQ. Before I move on to NASDAQ, let me check out the question. Can we buy gold at 1225? Of course, that is a possibility. Depends on how market reacts at 1225. If you ask me, if the price retraces towards here, then possibly we could buy gold, but it depends on when that happens. So if it happens within this week, let's say, because I don't try not to give such a long perspective. Anyway, next week we'll have another webinar, so I might as well just give for this week. If by this week price move really goes down to 1225 and it doesn't go down further, if it finds supports, then possibly with a bullish candlestick formation, possibly to go long as well. Okay, over here for your consideration as well. If the market goes towards 1225 and then fail to close lower and start to form a bullish candlestick formation, then you could consider going long after that. Thanks for the question. So this is gold. Okay, then yes, NASDAQ coming up. Okay, there's a request on NASDAQ. Let's look at NASDAQ. NASDAQ H4 chart. Okay, so this is NASDAQ H4. Okay, there's a gap over here over the weekend. So in any case, let's look at the momentum. As you can see, it was very strong in February, the early part of February, and then after that the momentum starts to slow down over here. You guys can see from the angle, okay, of the trend line. So the trend line that I draw is just to give you a perspective on the steepness. Steepness of the trend line will tell you how aggressive the momentum is. So this is upward momentum, and this is gradual, slowly tapering out. $5392. I think let's take this. Can just ignore the first two decimal place, quite insignificant. So 5392 there about is the area of conversion. So I'm going to zoom in so that you can see the candlestick. So as you can see the shadow, I'm quite how should I say, wary of shadows in this case. As you can see, a lot of shadows like go down quite significantly, as you can see from the chart, and then reverse all the way up. And then over here where my cursor is, as you can see all the shadow that just goes down and then go up, goes down and go up. And this is goes up and then comes down. So if you see a lot of shadows on a chart, the message that I'm deriving from it is the market is volatile. Okay. So just by looking at the chart, I will start to understand the characteristics at that point in time. Okay. Because characteristics of a currency or even stocks may change. So it may be, you may see a lot of shadow now, maybe a few months later, the chart starts to have less shadow. You never know. But just look at now, it just tells me it is volatile, meaning when I put a stop loss, chances is I will select a more conservative stop loss to avoid getting hit by all this shadow. Imagine if I put a aggressive stop loss and then the shadow just take my stop loss up and then goes in my direction. That would be a pity. So this would be the region that I'm looking out for. 1 point, no, why am I saying 1 point? 5392, and the other region is somewhere here, 5371, thereabout. Okay. So as you can see, there's a opening gap, but prices is sort of heading upwards to close up the gap. So a very short term refine of the entry. Okay, as you can see over here, there could be a mini so-called conversion region, 14406 or even lower, 05 maybe, 15405. Yeah. So there's a mini conversion. Looks like the price came down, broke, and then retraced back up. And from here, this could be a immediate decision region for the price to decide whether it's going down or going up, or continue to go up. So this would be my, if the candle closes above where my green box is, which is around 5409. Okay, about there, 5409. If the candle closes at 5409 or higher, I would consider to go long. Okay, let me mark the current candle. So of course, if some of you are trading the candlestick pattern, candlestick pattern trader, then you could consider after the 3 white soldier. Could consider enter after 3 white soldiers formation. Could consider entering. Okay. So could consider entering after 3 white soldiers formation. 3 white soldiers is a bullish formation. Why is called 3 white soldier? Because it's 3 white candles. And the other opposite is basically 3 black close for those who study candlestick formation. So this is a suggestion as well. So of course, if you are a price action trader like me, then my entry is slightly higher. I want it to close beyond the decision region of 5405. Okay. So this would be, of course, the first target would be somewhere here before it hits into the resistance or the last high. And my stop loss would be over here. So if I take into consideration possible shadow, like this kind of shadow that is coming down, then I could drag it further. Okay, if a shadow, it may pierce over here before going higher. So I drag it a bit more. So as you can see over here, again the risk reward is not as favorable, as in it is not 1:1 from your first target. And we need a more conservative stop loss in this case. So this is Nasdaq. Okay, the next pair would be dollar yen. Yes, finally someone put up a dollar yen request. The request is still coming in overwhelmed. So if in the event I have to end the session before I can take your request, so I'll apologize first. Due to time constraint, I may not be able to take all the requests. I do my best. So the next one is basically dollar yen H4 chart, and this is dollar yen H4 chart. Okay. Before I go back to the H4 chart, I just want to show you the daily chart to give you a perspective. So daily chart since this year 2017 is 201, the start of the year is where the vertical line is. So since the start of the year, dollar has been dropping. So why? Because Fed has set the expectation of 3 rate hike. So even though the 3 rate hike has not happened, but market is expecting that. So the bar has been set too high in my opinion. So a lot of times from January until now, Fed has been performing under the bar, so-called. So that's why it is giving the market impression that they are not hitting their target or whatever. So market is scaling back on there are 3 rate hike kind of tightening. So that's why you see the market selling off on the dollar. But as the time comes, if you ask me, once closer to if Fed can implement a second rate hike by first half June or even July, then possibly we see dollar yen starts to recover back towards 118. May not reach 118 level, but towards 118. But for now, I do expect dollar yen to be trapped at least in this very big range over here. I'll just mark the round number first. Then I'll zoom in back to the 4-hour chart. Oops. Let me see. Okay. So this is the 115 level. And this is the 112 level. Oops. $115 and at least from now until the next FOMC, I do expect dollar yen to be trapped within this 300 pips. Of course, unless there's I don't know, a big surprise that happens that is out of schedule, nobody have expected, then possibly we could see a big reaction in the price. But for now, at least for this week, I do expect it to be within this range. So let me go back to the H4 chart. Okay, as you can see a big range over there. So price is heading downwards towards 112. This is a H4 chart. So one of the possibility is to look for a buying signal around 112. So when the price hit into the 112 region, then I will look for a possible formation to go long. Okay. Formation could be in the form of bullish engulfing. So I don't need to zoom in the chart because it is still quite a fair distance away from 112. But I'll just type in the words so that you can anticipate what will I do if such things happen. So the first one is look for reversal chart pattern to go long. Wait, I have to be more specific. Look for reversal chart pattern around 112. Okay, the reversal chart pattern should be happening around the price of 112. But the entry may not be at 112. Depends on the chart pattern. So example, if around 112 it forms a double bottom, example. So if it forms a double bottom, then I have to see where is the neckline of the double bottom. So of course I can't predict where is the neckline now. I have to wait for it to form first. So assuming if price move in such a manner, it goes near or slightly beyond 112, bounce up, goes down, test again and goes up. This is a typical double bottom kind of reversal pattern. So over here will be the neckline. So then after the candle close above, that's where I will go long. Of course, the neckline, it could be at 112.40, it could be at 112.50, or it could be at 112.30. I don't know. I just wait for it to happen, if it happens. So that's one reversal pattern. Of course, other reversal pattern could be in the form of inverted head and shoulder. That is another reversal chart pattern. That's one option. Of course, the other option would be candlestick formation. And candlestick formation typically gives a faster entry. Because candlestick formation only need a maximum of 3 candles to form. Whereas chart patterns, double top, double bottom, will take slightly more candles, typically may go into a range of 20 candles or even more to have a formation. So this is 2 options for your consideration. The first option and second option. Okay, again, I'm going to put the vertical line. This is a time of the So that's a dollar yen for H4. Of course, if I go to lower time frame, I definitely, if you are trading a lower time frame, like H1 or even M15 or M5 chart, then possibly you could use a trend strategy to look for short. Because from the current price 112.70 to the support 112, there's still easily 70 pips. And if you are trading low time frame, 70 pips is a decent kind of margin, so-called profit margin for you to take 20 or 30 pips out of it. So this is a suggestion. If you are trading a low time frame, then possibly you could apply some trend strategy on a lower time frame to look to go short. Of course, try not to short around 112. That is to me a bit risky. It is into the high time frame support zone already. But price now, it could be an entry based on your strategy to go short. You could consider that. Okay, so there are a few questions. Let me just answer the questions. However, US last week's performance is much better than Canadian dollar. Why US dollar is weakened? Okay, this is a good question. It is not so much whether the data performs well or not. The focus is actually on FOMC and their interest rate decision. So of course, there's another question that asks why did the Fed increase interest rate but the dollar still weakened? These two questions actually sort of go hand in hand. Like I explained earlier at the beginning of the webinar, it is based on market expectation. When we are trading the markets, especially Forex, one thing we need to take note of is market expectation. What the market is expecting. So in this case, market is already expecting Fed to increase interest rate already. Okay, if they don't increase interest rate, the sell-off is even more crazy because that is what the market is expecting them to do already. It is not a question whether they are the chance of increasing interest rate is they are expecting 60% or 80%. It is close to 100%. So market, if they don't increase interest rate this time round, dollar yen will not just plunge 100 pips. Chances is it may go below 112. But in any case, They did meet the expectation of the market, so there's no surprise. Yes, if you stand on the market perspective, yeah, you just do what I expected. And the other thing is market is looking out for is some clarity towards the next rate hike. They want to know, are you going to increase interest rate June? Because if there's no clarity to the next rate hike, then they feel that there's no point holding on to the dollar position, and they start to so-called scale out. So those traders who are holding on to long position will start to cut their position. And then of course those who feel that since the rate hike is not going to be coming soon again, then they may sell the dollar in the near term. So that's why we see dollar yen dropping back towards 112. So it is not so much of data driven. It is more of expectation on what the central bank, Federal Reserve, is going to do. Okay, there's the question also related to Fed hike, but is on gold and silver. So I'll just read the question out. Why did gold and silver go up during the rate hike instead of going down like December? It was already given that there will be a rate hike, so shouldn't it shown down or stronger USD? Great question. If you look back in December, yes, the gold and silver went down after the rate hike. But more importantly, again, at that point in time, market is expecting the rate hike already. But the difference is because Fed set the expectation of another 3 rate hike this year. So if you recall in December, right, there was a expectation of 3 rate hikes in 2017. So way back, even before they start 2017, market already pricing in 3 rate hikes this year. So like I say, it is always based on market expectation. So now, if gold and silver has dropped so much because of 3 rate hike expectation, and since the early this year, there's a lot of speculation, how come there's no signal of Federal Reserve increasing interest rate? So in January and February, markets start to scale out or start to have doubt that Federal Reserve is going to have 3 rate hike this year. That's why we see gold and silver heading upwards. And finally, towards March, then Janet Yellen and the other Federal Reserve officials start to be aggressive in telling the market we are going to raise interest rate. So within 1 week or so, it actually switched the sentiment around. So that was mentioned in my webinar 2 weeks ago. If I remember correctly, that was 2 weeks ago. I did mention in one webinar, it should be the one 2 weeks ago. There was a switch in sentiment just within 1 week. So the switch is that because there's a lot of comments from Fed officials saying that they're going to increase interest rate. So that's why markets start to price in or start to expect interest rate hike in March. So now, after they expect March, they are always looking forward. When is the second one? So they are looking for clarity to have some assurance that Fed is still on track to increase interest rate in June. But there wasn't any clarity. So Janet Yellen just said, yes, we are still on track for 2 rate hike, but never mentioned when it's going to be. And market is not happy with that kind of answer, so they start to sell the dollar. So when they start to sell the dollar, gold and silver is likely to go up because gold and silver is inversely so-called correlated to the strength of the US dollar. So the situation in December and March is slightly different in terms of market expectation. Okay, The next question. If Theresa May really trigger Article 50, which based on today's news, they are scheduled to, or she's so-called scheduled to invoke it on 29 March, which is another 1 week plus. What could happen to the sterling? Will this weaken the currency and or push higher the sterling? Okay, when at the point of invoking really trigger Article 50, of course, there could be a knee-jerk reaction. Once they invoke Article 50 means they are starting to exit EU. So the immediate reaction could be a sell-off in the sterling. But why I say it's only immediate? Because the next thing is market will start to focus on the next thing. Usually after they react, they will start to look forward. Oh, let's say 29 March, invoke Article 50. They may sell. But after that, it could be 1 day or 2 days or even the same day. The market will say, oh yeah, the Article 50 is already invoked, already passed. So what's next? So the market is always asking this question, what's next? So what's next for the sterling will be, they will start to recall back, oh, Bank of England, the last statement, they are hawkish. So possibly if inflation still maintain high and exceeding their target at 2%, then market will start to speculate, oh, if the inflation is that high, then Bank of England may start to, or more members will start to seriously consider a rate hike. Then market will start to price in a rate hike for the sterling. And when that happens, sterling is likely to strengthen. Point number one. Point number two, after they invoke Article 50, it doesn't mean UK will exit immediately, because the interim period is they can't just live like that. There's a lot of policies, agreements that needs to be renegotiated and put in place. And it is a complicated process, and a lot of negotiations need to take place, which means take time. So the whole process will take months. And by the time UK officially exit EU, that could be 2 years later. So if market is worried about, when the UK economy is suffering after they exit EU, that could be 2 years later. And 2 years is a long time for things to happen in the market. So why worry now? So they may delay the effect. They say, oh, no point considering the effect of Brexit. Let the negotiation go on and see how it goes. So the concern of Brexit impact on UK will start to die down. And then, of course, when that happens, it is favorable for the sterling. If concern of a Brexit on UK economy starts to push backwards to a later date. So we do expect after the immediate reaction could be a sell-off in the sterling, but after that, the sterling may start to recover. So that is what I am expecting to happen when Theresa May invoke or trigger Article 50. Okay, someone asked about sterling yen. What will happen to sterling yen in this week? So this question is like asking me to tell the future. What will sterling yen happen this week? My direct answer is always I don't know what will happen to sterling yen this week. But I do know when sterling yen goes certain level, what would I do, whether to buy or sell. I'm always on the reaction mode because I'm a trader. First of all, I'm a trader, so I prefer to react to where the price goes, and I decide whether I want to go long or short. But on the fundamental side, to answer your question, what will happen to sterling yen this week? On the fundamental side, it should still be bullish on sterling yen. Okay, without looking at the chart, okay, just based on the fundamentals, there are some news that are coming up on sterling yen. So data is one driver for sterling yen. So if the data is good, of course sterling yen may continue to go up. But of course, if the data is bad, chances is sterling yen may go down. So that's the first driving force for sterling yen this week. So the key ones that I've highlighted during my second segment is the CPI for UK. Because last week's BOE concern is inflation. If inflation continue to surpass their target, then they want to increase interest rate sooner. So there is a clue that BOE is looking at inflation very much at this point in time. So that is where we should focus ourselves, the inflation data for this week. So that will be the main driver for sterling yen. Besides data, then it will be possibly the upward momentum on sterling yen may still continue for this week slightly further on a rate hike expectation. So that's my viewpoint for sterling yen. So time flies. We have come to the end of the webinar. So I hope that you enjoyed the session as usual, and you have find that whatever I've shared will help you set up nicely for the week. So once again, I look forward to seeing all of you on next Monday, same time, same channel. So this is Wayne signing off on behalf of Fullerton Markets. I wish everyone happy trading and may the pips be with all of you. Good night and bye-bye.